Thanks to our friends at The Motley Fool for sponsoring this video. Visit fool.com/ASYM for the top 10 stocks to buy right now. Part of the challenge with investing is avoiding companies that you shouldn't be owning in the first place. There are a number of stocks that have gotten a lot of hype from investors, and I see being very popular among retail investors that I think are absolute sells, stocks that I would avoid at all cost right now. So that's what I want to get into is 4 stocks that I would be avoiding today. My name is Travis Hoyam. Thanks for watching Asymmetric Investing. Please subscribe here on YouTube for all my content. And thanks to this video sponsor, The Motley Fool. Check out fool.com/ASYM for their top 10 stocks to buy right now. The first stock that I want to talk about is one that I have fallen into the trap, thinking that this is a value, that there's a lot of upside, and that is Snap. The social media company has a lot of really interesting technology in augmented reality. They have classes. They've got really cool tools, but their financials are absolutely terrible, and they continue to give away the business in stock-based compensation. So I want to go through a couple of numbers today to just highlight how poor of a business this is. This is from Snap's recent third quarter 2023 earnings report. You can see that revenue per user down 6% year over year to $2.93. Even in North America, revenue per user was down 4%. So just the wrong trends that you want to have for a company like Snap. Meanwhile, what is happening with their costs? Well, their adjusted cost of revenue is up 23% from a year ago. Part of this is infrastructure costs. They're spending more on things like artificial intelligence. But if you're not generating more revenue as a result, then what in the world are we doing? What you end up with is a company that is barely breaking even on an adjusted EBITDA basis. This is where a company like Snap can make all kinds of adjustments, pulling out stock-based compensation and things like that. But on a net income basis, losing over $300 million per quarter. And it doesn't seem like that is going to slow down anytime soon. I just want to mention here too, on the right, you can see the dilution that is happening over time. In yellow, you see common shares outstanding. And then in gray are the underlying stock-based awards. So continue to give away hundreds of millions of shares per year in stock to employees. One of the things that it has taken me time to really realize in social media is that this is a business that's really going to be winner take all. Meta is taking a vast majority of not only revenue, but probably 100% of the profits in the industry. A company like Snap not only has a smaller user base, it's generating less revenue per user. So as a result, you have much less opportunity for profits. I think of this as the smiling curve. In the top right, you have the company with the most scale generating the most profit, but there's only one company that can live there in the top right corner. Most of the companies are going to live somewhere in the middle at the bottom, generating very little profit despite having what seems like a very big user base. So companies that fall into this category, Snap, Reddit, we've seen MySpace fall into this in the past. And the only way to get out of this is becoming either much, much bigger or moving into a niche market where you can actually charge customers for what you're doing. So a company like Match.com is actually doing well doing that. But Snap is kind of stuck in no man's land. And I don't see that changing anytime soon. That's why it's a stock that I would avoid, because I don't see a recovery for Snap given the competitive dynamics in social media right now. The next stock is actually two companies that I would avoid, and they're both charging companies, that is ChargePoint and Blink Charging. These were very popular companies during the pandemic. It was very easy to see that electric vehicles were going to be the future. You're going to need chargers. So of course, why wouldn't ChargePoint and Blink Charging have a lot of tailwinds behind them? Couple of problems with that. One, neither company is profitable. They're making some money on the chargers that they sell, but they're not making nearly enough on either the chargers or their subscription or owned systems to pay for massive sales and marketing spending. So they're just spending way too much money selling these products and trying to drive that growth, and none of that money is flowing to the bottom line. As a result, you have negative net income, negative cash flow, and these problems only seem to be getting worse as these companies get bigger. That's why you see these stocks falling. And at a certain point, you just run out of options. If you're burning cash flow, once you burn through the cash on the balance sheet, now you got to find more cash. Are you going to sell stock? Well, if you have a falling stock price, That doesn't seem very attractive because $1 or $2 stock price isn't going to raise you enough money to drive the next phase of growth. Are you going to be able to sell debt? Well, now you have a low stock price and you're losing money. So debt investors are going to say, we're going to need to see profitability. Where is that profitability going to come from? There's no differentiation in either of their products. They're selling a commodity, electricity, through a commodity plug. A lot of investors saw the move to Tesla's NACS charging standard as a positive for charging companies, but it's actually going to commoditize them even more. So I think that just exacerbates their problems. These are both companies that I think are headed in the wrong direction. I would not be surprised if both of them need to go through a restructuring sometime over the next 5 years because their future does not look very bright in their current business model, especially as a company like Tesla starts to sell their chargers to other suppliers. So it's okay to be interested in electric vehicles and electric vehicle charging, but it doesn't mean that it's necessarily going to be a good business, even if there's a lot of revenue growth there. So that's why I would stay away from ChargePoint and Blink Charging. The final company is Plug Power. This is once again one of these companies that has promised us the world over and over again, gone through boom and bust cycles on the market. But this latest one is really starting to be a challenge for the company. We're starting to see cash burn at record levels. Again, another one of these companies that is growing extremely quickly, but is actually burning more and more cash as it grows. That's almost counterintuitive, but it's a terrible way to run a business. And I'm going to just go back. This is a company that in some of their previous cycles, management has said that they're going to be adjusted EBITDA positive by the end of 2016. So they have been making promises about being cash flow positive, adjusted EBITDA positive, some sort of sustainability level for nearly a decade now, just since I have been covering the stock. It has never actually happened. Doesn't mean that the stock hasn't gone up for periods of time, that it hasn't been a profitable trade for some investors. But if you are a buy and hold investor, you want to have a solid company underneath you. I believe in the future of hydrogen as a fuel source, but that doesn't mean that every company that is involved in hydrogen is going to be profitable. And these companies need to be able to prove that they can make money. Plug Power has not been able to do that. They have proven that they've been able to grow. They've grown primarily in retrofitting forklifts for hydrogen instead of batteries. That is the biggest piece of their business, is literally forklifts. Now they're trying to transition into other new markets like electrolyzers, like fuel for industrial and automotive applications, but that has not proven to be profitable in an environment where interest rates are rising, where investors are looking for companies that can actually make money. Plug Power is not that company. That is a big reason that the stock is dropping as much as it is, and why I would avoid this company at all costs. The big thing that's changed over the last few years is they've actually taken out debt. So that leaves less flexibility to do what they've done for decades, and that is sell more shares to stay afloat. So keep an eye on that balance sheet as Plug Power reports earnings for the next few quarters, but this is not a stock that I would want to be long right now. So the stocks we talked about today: in social media, Snap; in EV charging, ChargePoint and Blink Charging; and then in hydrogen, Plug Power. Those are all stocks that I would avoid. Let me know what you think about those companies in the comment section below. Don't forget to subscribe to Asymmetric Investing. Thanks for watching, everybody. See you here next time.